How to trade supply and demand zones in forex trading. Supply and demand zones in forex can be an effective approach for identifying potential market turning points and capturing profitable trades. Here's a step-by-step guide on how to trade supply and demand zones. 1. Identify key support and resistance levels. Start by identifying major support and resistance levels on your charts. These levels can be identified through swing highs and swing lows, previous price reversals, or chart patterns. These areas will serve as a foundation for locating potential supply and demand zones. 2. Locate supply and demand zones. A supply zone is an area where selling pressure exceeds buying pressure, causing prices to decline. A demand zone, on the other hand, is an area where buying pressure exceeds selling pressure, leading to price increases. Look for areas where price has reacted strongly, resulting in a significant imbalance between supply and demand. 3. Draw the zones. Once you identify potential supply and demand zones, mark them on your charts. Use horizontal lines to encompass the price range of each zone. Supply zones are typically drawn above the current price, while demand zones are drawn below it. 4. Validate the zones. To increase the reliability of your supply and demand zones, look for confluence with other technical factors. Consider factors such as previous price reactions, trend lines, moving averages, or chart patterns that align with the identified zones. The more confluence you have, the stronger the zone is likely to be. 5. Wait for price to return to the zones. Be patient and wait for price to revisit the supply or demand zone. This provides an opportunity to enter a trade. The idea is to buy at demand zones when price pulls back and sell at supply zones when price rallies. 6. Use confirmation signals. Don't rely solely on the presence of a supply or demand zone. Look for additional confirmation signals before entering a trade. These signals can include bullish or bearish candlestick patterns, trendline breaks, or the convergence of multiple indicators. The confirmation signals should align with your trading strategy and increase the probability of a successful trade. 7. Set entry, stop loss, and take profit levels. Determine your entry point at or near the supply or demand zone. Set your stop loss order just beyond the zone to limit potential losses in case the zone is invalidated. Calculate your take profit target based on the distance between the entry point and the next significant support or resistance level. Ensure that your risk-to-reward ratio is favorable for each trade. 8. Manage the trade. Once you enter the trade, manage it according to your trading plan. You can use trailing stop-loss orders to protect profits as the trade moves in your favor. Monitor price action and be prepared to exit the trade if the supply or demand zone is breached or if your predefined take-profit level is reached. Remember that supply and demand zones are not foolproof indicators. It's important to practice and gain experience in identifying and trading these zones effectively. Additionally, consider combining supply and demand zone analysis with other technical and fundamental factors for a more comprehensive trading approach. For more details, watch my other videos, subscribe, ask a question in the comments, or contact me via email.